Can you walk away from a pre-construction deal? No, you can't. But Ted and I will explain it. Let's begin.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Okay, so here's how it works. Ted, let's assume you are a real estate developer.
I gotta go change my clothes.
That's right. Put
right?
something fancy on.
Yep.
And you build these big apartment buildings. Okay. That's what you do.
Right.
Now you can build a purpose-built rental building, which means you're going to rent it out. That's why they call it purpose-built.
Yep.
Or you could build a condominium.
Yep.
Where once it's built, you sell each unit, you get your money back, you're done. Bing, bang, boom.
Okay.
Now, either way, you have to buy the land and get the architect and get the permits to build the building. So let's say that's going to cost you $100 million.
Okay, it cost me $100 million.
$100 million, and I just made that up. I have no idea. What do I know? We're just making stuff up here. So you go to the bank and they say, okay, we'll give you a mortgage on the raw land because there's nothing built here yet. So maybe they'll give you, I don't know, $10 million or something, but you're still $90 million short.
Right.
So what do? Well, you pre-sell the units that you're going to build.
Sure.
It's brilliant, right? So the typical deposit structure for somebody who's buying one of these units is you got to put some money down on signing. Maybe it's $10,000 or something.
Just something to close the deal.
Right. And then usually it's like, okay, 30 days later, you got to put down 5%. And then maybe after a year, you put down another 5%. So maybe you put down a 10% deposit.
Okay.
I talked to a guy yesterday who had put down, and he did the deal 2 or 3 years ago. He's only put down a 5% deposit.
Okay.
More typically, the people I'm talking to, it's more like 10% or maybe even higher.
Depends on how desirable the location is and stuff, right?
And what the builder can do. Yes,
Yeah.
if the units aren't selling, I guess he's got to be a little easier on the deposits. So my first question for you is, does a pre-construction condo cost more or less than an already existing building? So the question is, there's a tower already there and the units in that cost $800,000. What are you going to pay for a precon?
Right. So let's put this into terms that I understand. You're asking me, am I going to pay more for a brand new car that hasn't been built yet or a used car?
That's what I'm asking you.
Right. And so the new car is always going to cost more.
And why is that? Because you're not going to get it for 5 years, this new car.
But the assumption has to be that it's going to be that much nicer. Everything's shiny and exciting, and it's brand new.
And of course, prices always go up.
Sure.
So I'm locking in now at this higher price. Okay. So I actually did some research for this part.
Okay.
Here's a typical example, and you and I are getting these calls all the time, so this is not something new to us.
Right.
In February of 2022, back when you were a young man, right at the peak of the market, the average apartment condo in Toronto was selling for around $800,000.
Sounds reasonable.
And I'm getting these numbers from WOWA.ca, WOWA.ca. It's got all sorts of great data there. In January of 2021, prices were on average $600,000. So prices went up over 30% in just over a year. Right. You remember those times? Oh, there's
a return for you.
There's a return. Now, of course, you expect prices to go up forever, so you agree to pay $1 million for a condo that's probably going to take 5 years to build. Your shiny new thing that you just said.
There you go. Right.
So you put down a 10% deposit, which would be $100,000. And you assume that if condos are going to be up 30, if they were up 30% in the last year, well, they're certainly going to go up 30% in the next 5 years.
Right.
Probably a lot more. So I'll be paying $1 million for a condo that by the time it's finished will be worth $1.3 million.
Should be.
Maybe $1.5 million, whatever. Fantastic investment. And the trick here is you don't even have to, at the end, buy the condo.
Right.
You can do an assignment sale. So what's that?
You flip it to somebody else, right?
Right. So
you assign your rights to purchase it to somebody else.
That's what an assignment sale is.
Right.
So let's say that I've put down a $100,000 deposit.
Okay.
And I assign it to you, and you say, okay, well, I know it's going to be worth a lot more. I'll give you $200,000 for it.
Right.
So how much profit did I just make?
Well, so you put down 100, I just gave you 2, you doubled your money.
Doubled my money. What could be simpler? Now, that's what you hope is going to happen.
Right.
Now, let's say I keep the condo.
Okay.
And I wait until it's built and I buy it for $1 million.
You closed at the price you said to buy it for.
Right. And then let's say it's actually worth $1.5 million and I can sell it.
Okay.
So how much did I make there?
Well, so you paid $1 million, you sold it for $1.5 million, you made $500,000, 50%.
So that's still pretty good. even closing the
yes,
deal.
that's still pretty good.
Still pretty good. And that's the appeal of this whole precon thing.
Right.
Right?
As long as real estate goes up in value at a greater rate than what you've paid out, it's a win.
It's a win-win, right?
Okay.
You lock in the price now, you expect it to be worth a lot more in the future. So why are we doing this show then?
Right.
Isn't this called Debt Free in 30? Well,
because prices don't always go up forever.
Exactly.
And in fact, right now they are going.
Not so much. Yeah. Well, and so again, let's look at the numbers. I already said it. January of 2021, the average condo in the Greater Toronto area was around 600,000.
Mm-hmm.
By February of 2022, it had gone up to 800,000. By January of 2025, 670,000.
Gotcha.
So still up from where they were in 2021,
Yep.
but down from where they were in February 2022.
Mm-hmm.
And that's the problem. I'm getting calls from people who a few years ago agreed to buy a condo for $1 million.
Right.
And now that identical condo
Isn't worth it.
it's not worth it. It's worth maybe 700,000.
Right.
So I want you to do the math for me here.
Okay.
I paid $1 million,
Mm-hmm.
or I agreed to pay $1 million.
At some point, somebody's got to pay $1 million to close the deal.
That's the deal. I put down $100,000 deposit, so I need how much to close?
900,000.
This is pretty simple. Okay, now let's do the financing end of it.
Mm-hmm.
Because here's the problem. I've got decent credit,
Mm-hmm.
so I go to the bank, and the bank says, oh, well, yeah, we got these formulas.
Right.
The appraised value is $700,000.
So we'll give you 80% of that, right?
Which would be,
560,000.
okay, but I paid $1 million. I put $100,000 down.
So you got to come up with another 340 grand to close on
There's
this
a problem
deal.
here.
And you've already put 100,000 in.
Right. So I need 900,000.
Mm-hmm.
The bank's going to give me 560. I'm $340,000 short.
Right.
There's the problem.
But you can put that on your Visa.
Oh, yeah.
can't you?
I'd put it on my Visa. So then it wouldn't be a problem. But the issue is a lot of people don't have the ability to put $340,000 on the Visa. So I want to talk about what a buyer should do in that case. But let's talk about the builder for a minute here.
Sure. There's a ripple effect to this whole thing.
Yes, because in my scenario that I just made up, you were the builder.
Mm-hmm.
You were putting, it was going to cost you $100 million to build this building.
Right.
And throughout the process, the bank kept loaning you more and more money as the building was built.
Yep.
So let's say you've borrowed $100 million from the bank. Okay, if you can't sell any of these condos,
You're going to default on the bank.
that's a problem for the bank.
Yep. It's a problem for you and it's a problem for the bank.
So there's a whole bunch of problems here.
Right.
So, okay, the bank's in trouble, the builder's in trouble, the purchasers are in trouble.
Right.
So one of the tricks, I don't know if it's a trick or not.
It's a trick.
Let's call it a trick.
Call it whatever you want.
Let's call it a trick. So one of the tricks is, so I'm the banker,
Yep.
and I'm one of the big banks. So I not only give loans to builders, but I also give mortgages to regular people.
Right.
And I'm sitting there going, oh crap.
Mm-hmm.
This $100 million I loaned maybe is only worth $50 million. Because if the building doesn't close and it's like it's a ripple, like you said, it's a ripple effect.
Something has to happen.
So I know that nobody can get a mortgage because the building is appraising it, the units are appraising at 700,000, they need to be $1 million.
Mm-hmm.
So what if I do a blanket appraisal? What is a blanket appraisal?
So you basically say the building is worth this much money.
Yeah, each
So you
unit.
don't look at each individual unit. You look at the entire value of the entire building.
Yeah, and so in other words, I just make it up.
Right.
So what I do is I say to the builder, no problem. If your purchasers come to me, Mr.
Mhm.
Big Bank, I have decided that these units will appraise at $1 million.
Right.
Which therefore means 80% loan to value mortgage. You can get your 800,000.
The deal can close.
Yeah.
Everybody's happy.
And in my example, you've put down 100,000. You only need to come up with another 100,000. Or maybe I'll appraise them at $1 million too.
Right.
You can get the full mortgage. Everybody's happy.
Yep.
Why would a bank do that?
Well, so at the risk of the deals not closing, the builder then defaulting and then getting stuck with this building that now is in foreclosure or some kind of distressed sale, they at least can get the transactions done.
So what they're doing is kicking the can down the road here.
Exactly. What they're saying is that we think that at some point these units are going to be worth more than what we're mortgaging them for now.
So we give everyone a 5-year mortgage.
Mm-hmm.
And when the mortgage comes up for renewal in 5 years, well, we may just renew it again. Doesn't really matter what the building's worth. So long as everyone's able to make the payments, we're good.
You got to assume that none of these things are going to be CMHC insured mortgages.
Well,
I don't know if you can with a condo.
You can. Yeah. It's a regular unit, but and you're right. CMHC insurance applies if there's a 80%, less than 20% down payment.
Right.
Now, you raise an interesting point.
So the bank does this, and 3 years from now, they haven't gone up in value. Is CMHC the ones buying the farm?
And I think that's how insurance works. I would think CMHC would go, wait a minute. So you're putting in essentially fake appraisals, and we're on the hook for it?
But remember how CMHC works too. So the buyer of the condo defaults. The bank applies to CMHC for the insurance, and CMHC sues the condo buyer.
Right. And that's when they come in to see us. We're going to talk about that next.
It gets money.
Yep. So whether this is legit or not, I don't know. This is not a real estate show.
Right.
There are obviously a lot of people far smarter than us who actually understand this. The only reason I'm raising the issue is because we are starting to hear stories like this.
Well, because somebody's got to find a way out of this mess. Right? It's going to be a huge problem for a lot of people and a lot of builders, and therefore a lot of banks.
Right. And based on the numbers that I've seen on Twitter, so I know it has to be completely legit.
What's Twitter?
It's a thing where you go X. Sorry, you're right. I'm not using the right name. And I think, Ron Butler has posted that there's something like 55,000 condo units that are going to come on stream in 2025 and 2026. I'm not sure if he's talking about the GTA or what, but that's a big number. Mm-hmm. And I'm probably getting one phone call a day from people.
That's
I had a call yesterday from a guy whose deal isn't going to close for a few months, but he already knows he's underwater.
Yep.
So a blanket appraisal may be the way out, or allow them to kick the can down the road. Let's go back to the math here.
Yep.
So let's ignore everything I just said about blanket mortgages. Let's assume there's no tricks being played here.
Okay.
So back to the original example, $700,000 appraised value, 80% mortgage is $560,000. I need $900,000 to close. I'm short $340,000.
Right.
So the title of this episode is Can You Walk Away from a Precon Deal? So sure you can, but there's a pretty obvious implication here.
Right. So first is you're going to lose your deposit. Second is the builder probably has the right to sue you for the shortfall. So they're going to say, you didn't close on the deal. We're going to try and sell it to somebody else. Whatever they sell it for, they're going to sue you for the difference from what you contracted to pay in the first place.
This sounds like a big problem. A very, very
the lawyers are going to enjoy it.
Yeah, everybody will make money. Okay, so let's get to the practical advice section. I know we're only 12 minutes into the show, but let's get right to it.
Right.
So, and like I say, I talk to people almost every day with this exact situation. So I'm going to walk you through the advice I give them.
Okay.
And you can comment or tell me where I'm wrong or whatever.
Sure. Poke holes in it.
That's right. So the first issue, so this guy who called me yesterday.
Yep.
The issue is timing.
Mm-hmm.
Okay. So my first question is, when is the deal supposed to close? Right. So this guy I talked to yesterday, the deal is supposed to close in 9 months.
Well, that's a long time.
It's a long time. Now he's looking at the shortfall, kind of similar numbers that what we just talked about, $300,000 bucks. So my advice to him was, well, why don't you just wait and see what will happen over the next 9 months?
Right.
So what are the kind of things that could change in the next 9 months that could save this guy?
Well, you saw back in 2021, prices went from, what was it, 600 to 700,000 in a year, right? Or no, 600 to 800 in a year.
It was. Yeah, you're right, 600 to 800.
And so it's conceivable that in 9 months, maybe this whole thing corrects itself. I mean, it's possible.
Do you think that's going to happen?
I do not think. I think it's going to get worse.
Neither do I. But we're going through possibilities. So option number one, property goes up in value.
So interest rates could continue to drop, and they could drop enough that the real estate market, again, will reverse because now there's more money available to make the deals.
Yeah.
And maybe he can service more of the debt because the interest rate is lower.
Right. If the interest rate is 5%, I can afford a monthly payment of this much. If it goes down to 2%, well, I can afford a higher monthly payment. I can therefore buy a bigger property. Now, it's likely that interest rates will not be going up much over the rest of the year.
Yeah, but they're not going to go down much more either, I don't think.
Yeah, we don't know. We do our predictions podcast every December, and sometimes we're right and sometimes we're not. But again, this is purely speculation here. So what could happen? Real estate prices may go up, and it might not be the entire market. Maybe this particular building you bought.
You're in a great location. Somehow it's more desirable than all the others.
Everybody wants to live there.
Yep.
Second thing that could happen is interest rates could go down. That helps. What else could happen?
Well, So the banks are going to be in trouble if they don't figure something out. So maybe they do your blanket appraisal, or maybe they come up with some other clever solution that will allow them to mortgage the property for what you contracted to buy it for.
I wonder what the other clever solutions would be. Well, maybe one of the clever solutions is, we've got this deal with a alternative lender.
Mm-hmm.
So we'll do the first mortgage at the normal rates, and then we've already got someone lined up who maybe we're kind of helping backstop on the back end.
And they'll do interest only for the first couple of years or something until we need all sorts of,
because the problem is so big.
Right.
So, okay, so is there any point in this hypothetical example of this particular guy 9 months from closing doing anything today?
So I think they've done the right thing and they're looking for information, but I don't suggest they should do any actions at this time.
And that's what I said to the guy.
Just hold the fort.
Because, and we'll go through all the other actions, but like, okay, I guess you could go bankrupt today, but how much is your debt?
Right.
Don't know. Hasn't closed yet. And what if things do improve or even improve slightly? Well, then you went bankrupt for nothing. So, so I agree with you. My advice to this guy was, don't do anything today, because this particular guy had no other debts.
Yeah, so there's no reason to do anything else.
He had a car loan and that was it.
Yeah. So the king could die, I could die, the horse could learn to sing.
Exactly.
That's what we're talking about.
Lots of things could happen.
Aesop lives.
Exactly. Now, just to be clear, we don't actually think any of those things are going to happen.
No, the likelihood of any of this is pretty poor, that this guy's going to take a bath in the fall.
But even so, there's really no strong incentive to do anything today. Okay. Right. So then the second obvious thing is what you already mentioned before, which is the assignment sale. What is the likelihood that with a $300,000 shortfall built in, you could do an assignment sale?
Well, you could, but they'd want you to build in the shortfall already. So the assignment sale would be you giving them money to take over your contract.
That sounds like a reverse sale to me. So yeah, I've already put down $100,000, and I think in the math we did, the shortfall was going to be $300,000 over and above the $100,000.
340.
340,000.
Yep.
So, okay, I guess if you were to come to me, or if
Doug,
here's a good deal.
One day I would like to make you an offer.
That's right. And so the offer would be, okay, you give me $350,000.
Right. And I'll close this for you.
Okay, well, number one, you don't have that kind of money.
Well, and why would you do it? Because 9 months from now, something could change.
Right. So it doesn't make sense. So at this point in time, the assignment sale, not a big option. Okay, so let's brainstorm here. What's the next wacky idea you've got?
So talk to the builder. Maybe you can pay him some kind of penalty not to close.
So I know I'm going to lose $340,000. Maybe I go to the builder now and say, dude, how about I give you $100,000?
I've already given you $100,000, so now I'm giving you another deposit.
Now, what's going through the builder's mind when you come up with that idea?
So depending on what kind of resources the builder personally has, it's, well, is this thing going to correct itself so there won't be a $340,000 shortfall? So he'd have to be able to sell it for, well, at most like $150,000 shortfall. So because he's only got $200,000 in his pocket. So I don't think the builder goes for it.
Yeah, I don't think so either.
Maybe for $250,000 now.
But the builder has a big problem.
Right.
Because in order to create the condo corp, you have to sell a certain percentage of the units.
Yep.
And if I'd done my research, I could tell you what that percentage is, but I'm just making stuff up here. I don't know. Someone can leave the note in the comments if you're watching on YouTube or whatever. But so if it's like, okay, I'm going to be able to sell 80% of the units. I got, a couple, okay. Maybe I'll do a deal with you. But if your unit is $340,000 underwater, pretty much every unit is the same.
Great.
So as a builder, I'm taking a massive hit if I start making deals with everybody.
And there got to be builders that are thinking, well, okay, can I switch this from a condo to a rental property? But then it's a whole different math.
Yeah, and
it's not easy to do.
No,
right?
and condo buildings, particularly the small units, are built to be bought by investors,
right? And
the builder doesn't want to have anything to do with it. Yep. If you are building a rental, purpose-built rental, you build it completely different.
Sure.
You actually build it quality.
To be indestructible.
Right.
Right.
I'm going to build it better appliances, better everything, because I know that I have to service it over the next, 50 years or whatever. So, okay, the chances of making a deal directly with the builder are slim. Like you say, okay, the shortfall's $300,000. Maybe if I give the guy $250, he'll let me walk away. But if I'm going to be on the hook for $300 anyways, There's not a whole lot of reason for either person to be doing it.
Yeah, the only reason you'd consider doing that is if you've thought in your heart that, okay, it's going to be even worth less in 9 months as opposed to more.
And the builder thinks maybe it'll be worth more.
Right.
So, okay, long shot, but what the heck? Make the phone call, see what you can do.
Yep.
Okay, so let's go back to options then. So what else can I do then?
So you got 9 months to try and come up with $340,000.
Where would I get $340,000?
Remortgage your house, turn your RSP into a self-directed one that you're borrowing from it directly yourself. I don't know, second-tier lenders. This would not be easy to do because it'd be unsecured.
Yeah, it depends on what your situation is. So if you're somebody who has made lots of money flipping houses over the last 10 years and you've got some cash available, okay, well, I guess you can bail yourself out.
Right.
If your primary residence has gone up in value, then okay, I mean, getting $340,000 sounds like a big number to me, but maybe your mortgage is largely paid down.
Right.
Okay, you get the money from there, and you're borrowing at good rates because it's a mortgage.
Yeah.
And
any of this only makes sense if you're convinced that condo is going to go back up in value, so you're going to recover this money.
Well, but even if you're not convinced, you're on the hook for it.
Right. So you might as well have the thing since you're going to pay for it anyway.
Well, and in this particular made-up example, if you own your own house and it's got lots of equity in it, and you know that if you don't close, the builder's going to sue you,
right,
you're on the hook anyways.
They're going to get the money.
He's going to slap a judgment on your main house. So, okay, do you have any other assets you can liquidate? Now, you mentioned RRSPs. And yes, it is possible to hold a mortgage within your RRSP.
Yep.
We are not experts in that.
Right.
I don't know if you can have a second mortgage. I don't know what the terms are.
And the inherent risk is that, that's your retirement savings. If something goes wrong, you're screwing yourself twice.
Right. Now, of course, if you've got lots of money in your RSP, you could cash it in, but then you're paying a massive amount of taxes. So if I need $340,000 out of my RSP, I probably got to cash in $600,000. Doesn't sound like a brilliant idea to me.
Right.
Okay, so that gets to the commercial part of the show then, because if you can't wait it out, can't make an assignment sale, can't make a deal with the builder, don't have the cash to fund it yourself.
And they want the money now.
Yeah, so let's say we're
9 months have passed.
9 months have passed.
Nothing's changed.
And you didn't close on the deal. And so now the builder said, well, I'm suing you.
Right.
And I'm suing you for $340,000 in this example.
Yep.
So the obvious thought that pops into my head is, well, do a consumer proposal.
Right. But you can't do that because the limit on a consumer proposal is $250,000.
Ooh. And I thought that didn't apply when we were talking about real estate.
It applies to everything. So the mortgage on your principal residence is excluded from that total. All other debts are included.
So you can't do a consumer proposal.
Not in this particular example.
It's a pretty simple.
Now, husband and wife own the condo. There'd be two of them. The limit would be $500,000. They could.
Now, of course, it's unusual that you're in this situation and have zero other debts.
Right.
So you've probably got some credit cards, bank loans, whatever.
Yep.
So that is a critically key point. The debt limit for unsecured debt, not including the mortgage on your principal residence, and this isn't your principal residence.
No, you're buying this as an investment.
You're buying this as an investment. And in fact, you didn't buy it and it cratered and you're getting sued for the shortfall. So clearly it's not your principal residence.
Yep.
The limit is $250,000. So if you tried to file a consumer proposal, the superintendent of bankruptcy system would just kick it out and say you can't do it.
Right.
Okay, so what kind of proposal can I do?
So there's a second type of proposal called a Division 1 proposal that has no such limits. The catch with a Division 1 proposal, though, is if we can't actually reach a deal with them, you're deemed to be bankrupt.
So the gun is to your head. It's a pretty risky deal.
You got to get it done.
And so in a Division 1 proposal, just like a consumer proposal, we go to the creditors and we say, well, look, I can't pay $340,000. Here's what I can pay.
Right.
So maybe I can pay $1,000 a month for the next 5 years, 60 grand. What are the chances that the builder, who is going to be the majority creditor, they're the ones who are deciding on this, what are the chances of them saying yes to that deal?
Well, the math they've got to do is if we say no and you end up bankrupt, what are we going to get? You've got to offer them enough in the proposal that the deal is worth taking the risk that over the next 5 years you're going to pay them that extra money.
And so let's go to the
cash flow question.
Let's go to the final option then, which is bankruptcy then.
So bankruptcy, you're saying, look, I can't pay you. And then, so the cost of bankruptcy is based on a number of factors. The other things that you own. So if you've got net worth accumulated in something else, your income, the number of people that you're supporting, how many people in your household.
And it's math.
Yes.
It's just math.
And it's black and white.
It's black and white. So when you come in to see us, and you and I have been doing this for 30 years, I guess only 26 years at Hoyes Michalos and Associates.
Right.
We started it when we were 10.
Someplace else.
Exactly. So you come in to see us and we go, okay, well, do you have any assets? Well, no, I've already depleted them or whatever.
Yep.
Okay, so what's your income? We do the math. This is how much you'd have to pay every month in a bankruptcy. So the concept, as you said, behind a proposal, whether it's a consumer proposal or a Division 1, is we got to offer a little bit more than that.
Right.
And so if a bankruptcy is going to cost you $10,000 and your debts are $340,000, is there really any point in doing a Division 1 proposal?
It's unlikely because any offer you're going to make them probably isn't going to be sufficient for them to want to wait.
And so I guess what we could do is we could say, okay, you know what can you afford to pay? Maybe you can afford to pay 20, 30, 40 grand, 50 grand over the next 5 years.
Right.
We offer the proposal. We don't think it's got a great likelihood of working, but it is better than a bankruptcy.
Right.
And if the builder is seeing a bunch of these, maybe they'll take the deal.
Maybe.
And if they don't, well, you're bankrupt anyways, which is what we were probably going to do anyways.
Yeah. So the risk is we tried something that didn't work.
What is the timing then? So when should I be having this conversation with you?
Well, so I'm a believer that the sooner you get information about your options, the better. So in this example we started with, the guy had 9 months before it was going to close. Talking to us now is a good idea. Talking to us again just before it closes, an excellent idea. After it does close and it's hit the fan, or it doesn't close, and you definitely have to. But so sooner is always better than later.
So do you have to wait until the builder officially sues you and gets a judgment before doing a proposal or a bankruptcy?
You don't, because the debt is there. And the question is, do they need to get a judgment against you to make it legally binding? You got a contract. I don't think you do.
So it's really a question of timing from your point of view.
Right. What makes the most sense for you? How much time are they going to actually give you to do this? Most builders are not very quick to sue. So they've got 2 years from the date that the deal didn't close to actually bring action against you. Many of them won't actually bring that action until, 23 months.
Yeah, I mean, probably they're certainly waiting 6 months or a year because...
Well, they're hopeful that some other thing will happen.
Well, and they also probably know you don't have any money. That's why the deal didn't close.
Right.
So they pretty much have to sue you. This is a big number. They want the tax write-off, whatever. But they're not going to be in a big rush to do it. I suspect what will happen is there will be some buildings where a significant portion of the purchasers can't close.
Right.
The builder will have a deal with a law firm to say, okay, you got to bang out 50 lawsuits. Give me a deal.
Get it done.
Pretty much standard paperwork, off we go. So your advice is, if you think you've got a problem in this area, talk to a licensed insolvency trustee now.
Sooner is better than later.
Because then at least we can we can have a plan.
Right. And if you wait till the gun's to your head, well, then you have fewer options because you've got to do something quickly and you may not have the time to put your ducks in a row.
Yeah. If your wages are already being garnished, then we got to do something like this week.
Right.
Whereas if the deal isn't going to close for 9 months, okay, well, let's talk about it. Let's see what your situation is. And then we can just work with you throughout that process.
How do you feel about Bolivia?
That's right. Do you want to just leave the country? Well, and a significant percentage of the people I'm talking to are immigrants.
Mm-hmm.
The guy I talked to yesterday has been in the country for 7 years.
Right.
He's a smart guy, runs his own company, good job, the whole bit. And, came to this country, had a little bit of money. Great. Sounds like a pretty good investment. So yes, there will be some people who just say, okay, I'm bailing on the whole thing. But these are all things that we can help you with up front.
Right.
So I agree. Sooner you call us, the better.
Information is always a useful tool to have.
There you go. So that is our take on pre-construction condos. And as Ted said, you can give our firm a call, Hoyes Michalos and Associates. Ted or I or any of our other associates can help you out. Hoyes.com is our company address. We also have a monthly newsletter, which comes out every month. That's why we call it a monthly.
Funny how that works.
Monthly newsletter. It's focused on a financial topic to help you stay motivated and living debt-free. It's not about consumer proposals or bankruptcy.
Yeah, it's not a commercial for us. It's financial tools that improve your financial literacy.
Absolutely right. We've got well over 50,000 subscribers. And when I told you that, you said, why don't we have sponsors? Because if we
why isn't somebody monetizing
exactly. There
this?
you go.
What are we doing wrong?
I don't know. We don't have a sponsor for this podcast. We don't have a sponsor for the newsletter. We do have usually a giveaway every month for subscribers. So if you aren't subscribed, just click a link in the description and you can subscribe. Obviously, we want you to like and subscribe on YouTube, Spotify, all the different things. Next week, Ted and I will be back with episode number 550.
Are we going to have a special?
I don't think so. I don't know what we're going to talk. It's just a number, but we'll see. And so actually what we're planning to do is we're going to answer the question about whether you can have debt and still grow your wealth.
Okay.
There's a couple of ways we could go with that. It's kind of like those fitness videos where, okay, I want to lose weight, but I also want to build strength. Can I do the same thing? Maybe we'll do weightlifting or something next week too.
Gotcha.
So that's next week, episode 550. That is our show for today. Until next week, thanks for listening. I'm Doug Hoyes. That was Debt Free in 30. Oh, look at that. Look at that. Doesn't get any better.
You ran long, 7 seconds.